Ladies and gentlemen, a very warm welcome to this Grant Thornton Bharat webinar on what our finance minister called her first budget of this Amrit Kal. Our opportunity to decode that for you, and not just the budget, I guess also the economic survey from yesterday. Thank you very much to over 1,500 of you to have registered to join us for this, and I know we are also live on many social media platforms. I would like to open by giving you my high-level summary of what I thought this budget was all about. So I'd say exactly like last year, I believe once again we've seen a budget that stands for those three things: simplicity, consistency, and alignment. Simplicity, consistency, and alignment. And really again, three themes stand out for me from that budget: fiscal prudence, of course that capex focus, and finally also a boost to consumption. Other standout themes, of course, there were also inclusive growth, as one expected, then the job creation and the like. Inclusive growth and job creation. Leveraging technology stood out through the budget, and finally furtherance of that trust-based governance, so important to this regime. Of course, the fine print is still being evaluated by our experts, and this is all about hearing from some of those experts over the course of this hour. But some of the ones out there that already are causing some flutter are things like that liberalized remittance scheme, LRS, TCS going up from 5% to 20%, other than education. The change in GST, capital gains tax rollover exemption on properties, with a 10 crore limit now when you sell a property and want to reinvest the gain. And that again, big shift on CSR spend, the 18% tax when you pay out your CSR to an NGO or projects, the exemption on that not being available anymore. Of course, people will also talk about the misses around some of the rationalization that was expected around capital gains tax, CGT, the misses around rationalization of TDS, etc. And of course, the experts will call out on that. But the government will make it clear, as they have, that budget isn't the only day to progress on some of those aspects. And I continue to maintain perhaps it is time for us to start regarding 31st January, the day our economic survey comes out, as at least an equally important day as budget day, as we gain pace as a nation, heading firmly into that Amrit Kal, India at 100. And therefore, let me quickly summarize the economic survey before I get into my top picks from the budget. So top 5 things from the economic survey were: number one, that GDP growth, 6 to 6.8%, likely 6.5 rate. The economic survey presentation calling out the recovery was complete, that balance sheets, not just corporate balance sheets, but also bank balance sheets and NBFC balance sheets, non-banking financial company balance sheets, were all deleveraged and therefore ready to support the capital formation in the economy. The government's firmly seeing private sector as a partner on that journey, that simplification of corporate tax rate, the PLI scheme, etc. that was announced. And of course, not just the first generation of physical and capital expenditure, but now the second generation of that with things like further spend on national logistics policy, Gati Shakti and the like. On the physical infrastructure side, today we saw on the railway side, which some would have said was ignored earlier, but also the digital side with things like the ONDC, etc. Firmly, the physical and virtual infrastructure both getting firm recognition in that economic survey. And of course, finally, also that push on inclusive growth and job creation. The economic survey also talks about the future outlook. Where should our focus be? And 2 things stood out for me there. 3 things actually. First of all, enforcing contracts. Enforcing contracts was recognized in that ease of doing business index of the World Bank as something where India was amongst the bottom of the list in that ranking. And it's great to see the economic survey call that out, that we have to get better at the ability to enforce contracts if we have to progress as an economy. It also called out, I think for the first time I've heard anybody in government calling out the middle stand, Of course, it talked about the middle stand as the MSMEs. The middle stand is firmly referred to as in the context of the German middle market. The huge opportunity if we were to look at the potential of that middle market and how it would benefit, of course, the MSMEs, of course, the big corporates as well, but create thousands of future leaders who would always put Bharat first. So first time somebody talked about the middle stand, and then finally women power. The huge opportunity and the loss if we are not able to incentivize and include our women into the labor force. Moving firmly onto the budget, what were my top 5 picks from the budget that I saw at a high level before the experts get into it? Of course, fiscal prudence stood out, not just delivering the on the 6.4% fiscal deficit budget estimate of last year, but also firmly reiterating the commitment towards the glide path of FY26 of 4.5%, setting the target for next year at 5.9%, which is FY24, perhaps 5.2% in the year after that. She hasn't said that, but probably that's the sort of number to look at. Question to ask, could we now ask for a sovereign rating upgrade perhaps? As people were talking, if we miss that, the potential of a downgrade. So firmly, I'd say the first point to note there is that fiscal prudence. Second one, I'd say, is inclusive growth. Bottom of the pyramid stood out right at the beginning, that focus on women's self-help groups, artisans, tourism, agriculture, etc., all aligned to our priorities at Grant Thornton Bharat, helping shape a more vibrant Bharat and sectors where we are really, the market leaders. The third, for the first time, I noticed progressive thinking on things like recognizing the loss of learning that happened during the pandemic, the loss of learning in our children who missed 2 years of in-person education and the need to address that. Second one I noticed there was supporting the poor prisoners who are poor, who don't have the ability to fund their bail amounts and are sitting in prison. I really think that has to be complemented as a change of thinking in this government for a new India. The fourth aspect, I'd say, was announcing long overdue catch-up in the areas of artificial intelligence and soft power. Soft power is a theme I've been promoting since 2017. The hard power will come as India becomes that 5 trillion, 10 trillion economy. But soft power, which comes through things like tourism, things like those data embassies we heard about, is really going to propel the real value of India. And artificial intelligence is where we're so far behind, not just the US and China, but so many other economies. So great to see, those 3 centers of excellence that were announced, and in a way that will be a partnership with academia and a partnership with the private sector. And last but not the least, if I can call it out, there was also that announcement on capping the surcharge on the highest income earners, people who earn more than 5 crores, now capping the surcharge, which will reduce that highest rate from near 43% to 39%. Almost an anti-populist measure. I would call it an anti-populist measure. People would have expected populist measures going into this budget, as people were talking about. And you have to give credit to the government to recognize that we were becoming anti-competitive and therefore opening up the thought in people's mind on considering the Singapore, Dubai, etc. option. Not enough, but a great start on that. And I really feel overall, if I have to sum up, a furtherance of that trust-based governance, a furtherance of the theme we've seen over the last couple of years on simplicity and overall alignment of the budget. Sabke Saath, Sabka Vikas, as the government calls it. Thank you very much for joining us, ladies and gentlemen. I'd like to hand it over to Vikas Vasal with that note on Sabke Saath, Sabka Vikas. Vikas is our global leader of tax at Grant Thornton International, as well as a national managing partner of tax at Grant Thornton Bharat. Vikas Vasal.
Thank you, Vishesh. Thank you very much for joining us today and providing us a perspective as to what you and the India Inc. is thinking in terms of the business leaders and the decision makers. Again, a very positive budget. Let me first introduce our panel members for discussion today. I have with me Riaz Thingna, who is a direct ex partner with Grant Thornton Bharat. With him, we have Dr. Jajit Bhattacharya, who is the President Center for Digital Economy Policy Research and also the founder and CEO for Cardse, Zerom. We also have our indirect tax partner, Krishan Arora, and also Richa Sani, who is a chartered accountant who focuses on tax policy. Building upon what Vishesh just mentioned, if there is one phrase that we can use for yesterday's announcements in the economic survey, I think that will be all is well. At least all is well domestically. And if I have to caveat like a prudent professional, then I would caveat that all is well domestically, subject to the global headwinds, and hopefully we shall be able to navigate the same. Today, Honorable Finance Minister made some announcements in the budget, and again they were building upon the same theme as the economic survey. Huge amount of capital expenditure, infrastructure development, all-round inclusive development, that's the need of the hour. Frankly, no major surprises for the corporate ink except for few finer points that we shall cover, and putting more money in the hands of the individual taxpayers, which has been the ask for many budgets in the last few months. With this, let me come straight to Jayjeet. Jayjeet, what do you think is the underlying theme of the budget this year in terms of providing the long-term economic growth? We all knew that this will be the last full budget, but we do not see any major announcements on that count in terms of whether how do we want to support the masses, etc. The whole focus is on the long-term development and nation building. Your take.
I think I'll start with the last point that you mentioned, because that even though it is not really a populist budget, but it does address the small portion of the middle class who pay direct taxes. Now that small portion is roughly about 5%, but that impacts 20% of the population because each household has got 4 people. So in a way, it is really impacting 20% of the population, and it was something that was much needed because, as Vishesh just mentioned a little while ago, you can't be disincentivizing the citizens and pushing them out of the country. So you can't really call it populism, but there was something for a large majority of the people. Having said that, it's not just all is well with India. We are at a position of strength. If you look at agriculture, which is the backbone of our economy, we have been growing at 4.6% year on year for the last 6 years, which is tremendous for agriculture, right? It's not a dot-com industry. It's a primary industry. So a primary industry growing at 4.6% is tremendous. Along with it, if you look at the impact it has had on the per capita income, we are now at $2,500 per capita. That is tremendous. We have grown, we almost doubled our per capita in the last 6 to 7 years. Related to that, because we have prosperity creeping in, the data points show that our tax collections have actually gone up by over 15% last year, in just 1 year, which just reflects the fact that per capita income is really going up, agriculture is really going up, and therefore the tax collections have also gone up. The tax collection going up is also a reflection of the formalization of the economy. Because more and more of the economy has got formalized, people can't escape GST. So along with GST, along with direct tax, we've got a gross increase of 15.5% in taxation. Now, as Vishesh mentioned a little while ago, in terms of even the fiscal deficit, we have been now back on a glide path to come to 4.5% in the next financial year. So by 2025, we should be back on track in terms of having a 4.5% fiscal deficit, which is huge because it was unbelievable that we will be able to come back to that glide path a year, 2 years ago, given the massacre that was happening from an economic and a fiscal perspective. Lastly, if you look at the inflation figures, which is always a pain, we have seen the inflation figures in our neighboring countries, Sri Lanka going down, Pakistan is rapidly going into a turmoil. We are sitting prime where our inflation has gone down to 5.7% in December. Our tolerance level is 6%. We had reached it massively for quite some time because of the global issues that were there. Now we are comfortably back at 5.7%, which means from a finance ministry perspective, the pressures to get more budgets and to extract from the economy is much more reduced, which is why we see that she's been able to give about 35,000 crores back to the middle class in form of the tax breaks. Why is that important? Is because that 35,000 crores will go into expenditure, into additional money in the hands of people, which will get spent which will further accelerate the economy. Now, having said that, the economy is still having a challenge from the fact that it's very well entrenched with the global economy. It's very enmeshed. The global economy, as we are looking at it, has headwinds. Now, even though we are saying there's headwinds, there are a lot of firings happening from the big techs, we see the headlines every day. Some of the economies still seem to be coming back on track, like UK and so on and so forth. They seem to be coming back on track. But one of the real fears of the next financial year is the literal headwinds. What I mean by that is significant climate change issues coming in. We have seen 2/3 of Pakistan going underwater, and it's a large country. We have seen significant damage happening in Europe, in China, and so on. So besides the man-made conflicts, which is the war that we're seeing in Eastern Europe, which has led to huge impact on food supplies, on food prices, on fertilizer prices, which also an input into food, into oil prices. I personally feel that there will be a huge impact from climate change in the coming year. That has not really been factored in. Also, when we look at the economic survey, it kind of says that we'll be okay from a current account deficit perspective because the global growth will be low, so the demand on fuel will be low, so the fuel prices will be lower, and therefore our current account deficit will be lower. I'm not entirely sure whether I can buy that argument because if we really want to bring current account deficit, we stop consuming everything, and the current account deficit will be zero. The fact that India itself is 16% of global population, we are one of the largest procurers of energy. Unless we move away from the traditional forms of energy, we will ourselves put pressure on the energy market. And I think we really can't bet on the fact that others will not consume energy as we move forward. Everybody is an energy guzzler. If they stop doing that, then that will have a positive impact on the climate, but we don't see that happening, at least next year. From that perspective, I think another key point in the budget itself was the focus on new industries. When it talked about agriculture, it was not just pumping in money, but it was pumping in money for the agriculture to move into a new direction, which is focused on millets, which consumes less water, focus on non-chemical fertilizers, non-chemical pesticides, and so on and so forth. Similarly, if you look at, let's say, diamonds, it was focusing on environmentally safe diamonds, which do not do damage to the environment, and therefore lab-grown diamonds, and so on and so forth. Similarly, if you look at some of the other initiatives that they were talking about, AI and quantum and so on, was pushing each of the industries into a new industry or the next generation of industry, which is what is really needed for this country, because we are at a position of strength, we can take the chances, and I think that's what the budget tried to do.
Excellent, Jayjeet. I think there is also a maturity element coming in the budget and the rhetoric that we have in terms of the entire narrative. I think we are not considering ourselves any more poor nation now, right? And the thought process is that we are forward-looking and we are ready for the world. That's why there's so much discussion about AI, about the new centers of excellence being developed and taking it forward to the next level. Before I come back to you and debate with you on the oil prices as well as the revenue collection targets for the next year, let me bring in some cheer with Richa in terms of the old policy, new policy, or the default policy, and leaving more money in the hands of the taxpayer. Richa, enlighten us, how much more money are we going to get?
Thank you, Vikas. I'm already smiling on behalf of the common man. So this optional tax regime, which was how it was called earlier, it's now become the default tax regime. So what it means is that unless and until you opt out from that regime, you are covered within its ambit. Now this option can be exercised by a taxpayer who is a non-business taxpayer on a year-to-year basis. So a case-by-case analysis every year can be done. As far as the business taxpayers are concerned, this option can be exercised only once. The important aspect is that the coverage has been enhanced. Earlier, it was limited to individuals and HUFs. Now, under the revised ambit, it covers AOPs, BOIs, and artificial juridical person. So, if we look at it in totality, this concessional tax regime or this regime, which is less complicated, is now available to a lot of taxpayers within the tax jurisdiction. The slab rates have been reduced from 7 to 6 slabs. Rationalization on the rate front has happened, where the 25% rate has been removed. So from 20, you move directly to 30. The basic exemption limit, which was being demanded for quite a long time now, has been increased from 2.5 lakh to 3 lakh. The standard deduction is now available, which is again something which is a lot to cheer about. And the best part is that there is now the data which reveal that this was not a very popular regime with the taxpayer now. This is going to change, I feel, and it's not only for a certain section of taxpayers, but for a vast variety of taxpayers, if we take into account the reduction in surcharge for HNIs as well.
So Richa, you raised a very pertinent point. I think there has been a lot of demand that we have become one of the highest effective tax-paying communities at the upper end of the income levels. I think this is a significant change. Even though monetarily, yes, there is a reduction by about 4 percentage points, but I think it's more directional, where we can say with confidence that the government is listening to the different stakeholders, and we should see more changes as we go along. Any thoughts on whether the government had the leeway to reduce it further, or I think directionally we should be happy with the reduction for the high earners, which has been reduced from 43% now?
If you look at taxpayers' demands, they are obviously endless, but I think this is fiscal prudence which has been shown. So I think just the right tweaks to my mind have been done. There were a lot of demands, but I think this was one of the big pain points which was being highlighted in various tax and various other forums. So I think, to my mind, it is just the right tweak.
Maybe I can just add to what Richa was saying. Even the threshold limits for rebate have been increased from 5 lakhs to 7 lakhs, and that could give a significant benefit to the common man.
So effectively what we are saying is there will be good amount of money which will be left in the hands of the individual taxpayers to spend. And borrowing from what Jaji just mentioned, we are talking about not just 5%, 5 into 4 households, 20% of the population gets benefited. And if that actually gets spent on buying a refrigerator or a television set or going on a domestic tourism, I think it will provide a lot of boost to the economy. Riyaz, there is something in the fine print which I think many individuals need to worry about. That is in terms of the increase in TCS on the foreign remittances. It has been done, to my mind, quietly in the fine print. Enlighten us, what exactly does it mean, especially in terms of the LRS?
Sure. I think this, you're right, it is quite significant. Vishesh also referred to it in his opening remarks. So especially as today, when you have a lot of family members in different countries, the LRS route or the liberalized remittance route for sending money out for various reasons is being used more and more. Now, about 2 years ago, we had introduced the concept of TCS, tax collection at source, and for education purposes, it was retained at 0.5%, which is very nominal, but for all other purposes, it was put up at 5%. Now, there was also a threshold which said that if you made a remittance of over rupees 7 lakhs, then only would TCS apply. Now, quietly, the change that has come in is that this threshold of 7 lakhs has been removed, and the rate has been increased from 5% to 20%. It can be argued that in any case, it is just a mode of payment, and credit for that will be available from tax, but I think 20% could have a significant impact on the cash flow. So I think that is something that will affect a lot of people.
And what do you think could be the underlying reason for increasing this limit now?
So I guess it is all about making sure that collection of tax happens at the right time, at the first instance, instead of waiting for the end of the year and compliance thereafter. Also, given the fact that not everybody who makes a remittance may be actually filing the tax returns, I think TCS ensures that there is a trail of at least the taxpayers and make sure that the potential taxpayers are also brought in.
So information is available with the authorities at the right point in time, and they can take necessary action as required, but individuals can claim credit in their personal tax returns.
Absolutely.
Okay. Customs. Krishan, we know GST is outside the purview of the budget, but there is a significant change which will come to, which impacts the corporate Inc. as well as on the CSR activity, but that we'll cover a bit later in the discussion. There have been some rationalization in customs duties, which is a very welcome move. I think we were looking at more technological integration within the customs department, just like we have seen in the GST as well as income tax. So give us a brief of what actually has happened in the fine print in the customs duty side.
Sure, because I think over the last few years, the customs, regime which is getting rationalized is directly in line with the theme of the Atmanirbhar Bharat, Make in India, which basically encourages all the Indian manufacturing. What you're actually doing is, apart from incentivizing people on production-linked incentives, there is a phased manufacturing plan, PMP, which is what was introduced by the government. In the last 6 years, if you actually see, instead of actually bringing exemptions and reducing rates, what has happened is they have started increasing the duty rates for products and for sectors which are where the Make in India or the impetus to grow actually is in India. So what they want to do is basically you build in India, source from India, export from India, and also take cater to the raw material requirements of the Indian manufacturers who manufacture the ultimate finished goods. So what has happened here is that in that continuation of that theme, almost 4,000 tariff items, which is 1/3 of the total tariff of customs, the rates have actually gone upwards. The calibration is continuing. In that spirit, again, the calibration is continuing now in various sectors, metal products, electronics, footwear, leather, all of these items, MSME goods, all of these sectors eventually have witnessed a rate which has gone up, and it is not a negative for the Indian economy. It's actually to promote and encourage more and more production in India. And gone are the days where exemptions on customs were the drivers of the Indian manufacturing. It is not the case anymore. But what they really want to do is they want Indian manufacturers to actually flourish, and that's the theme on which the initial thrust sectors of the economy, which were earlier given the PLI incentive. While we have not heard too much on the PLI, and that can be probably something which government is still thinking of how to roll it out in the next few months as they come. But what you look at here is that you have continued to rationalize the duty structure on these products with the theme of one, increase the duty rates wherever required to discourage direct import of finished goods. These are the sectors where you are already pushing for growth. They are the sectors which are driven. There are about 24 sub-sectors which have been identified, which includes furniture, toys, sporting goods, etc. All of these, rather than giving them PLI, at least they have continued that incentive in terms of asking them to encourage and manufacture more. On the other hand, they've also done continued with certain limited exemptions, and about 196 product exemptions are there, which have been continued. But there is a phase-wise elimination of that phase. This 1, 2 to 5 years in which these products will ultimately get phased out with the exemption, and there will be no more exemptions on those products. What they are trying to build is that if you're not able to source that material, or there's scarcity of procuring that material, the Indian domestic component manufacturing is still not, backward integration not happened. You have actually entitled them to continue to import them at a subsidized rate so that you're able to manufacture. It also probably looks at, what was called the inverted duty structure. While we've only heard few items, household items in like kitchen equipment, etc., where inverted duty structure has been addressed. But I would say the last theme of how the rationalization of customs has happened is revolving around the fact that you make in India and then build in India and export from India. On the other side, if you see, there is also focus on green energy. And in that, if you look at the sector like EV vehicles, that is what the future of the overall automobile industry is. There was high demand that the duty rate should come down on the vehicles, but what they've done is on the procurement of the capital goods for lithium-ion cells, which are used in the battery, which is manufactured for the which is a major component for the EV industry. They have actually the rates have actually come down. Similarly, for that similar initiatives which have been made on the side where you are able to now showcase that we are able to create the green environment. There are initiatives which are revolving around that. So green energy, make in India, build from India is the theme of customs rationalization reforms.
Great. So rationalization of the customs regime is primarily in terms of integrating it with the simplification and alignment with the overall theme of the tax policy, simplicity and certainty and predictability. and easier compliances. And when we talk about customs, Jajit, we are bound to talk about the exports as well. 3 themes I would like you to deliberate upon. First, if we are saying that the global economy may see a slowdown, and this narrative keeps changing to my mind almost every month. Till December, whatever we were reading in the Western press was that one after the other, everybody was saying that Europe is going to hit recession and could be mild recession in US as well. Fast forward by just 30 days, now we are hearing is that probably other than UK, the rest of the Eurozone may escape that. But if it happens, a slowdown or recession, our exports will get hit, number one. We do not know what will be the rhetoric on the oil prices because we have seen huge swings, 80 to 120 and then back. And third, your optimism on the tax collections. I think you are one of the rare economists whom I can call who is very optimist rather than pessimist. So on these 3 themes, how do we build up? Because financial year 24 numbers of 6 to 6.8% or the base case of 6.5% are built on these themes.
So I think let me take a different example before I come down to answer your question, is that even though I said everything seems to be hunky-dory with India, if you look at the revenues of cement companies across the board, they are severely challenged.
Okay.
Right now, how do you reconcile that with the fact that house demand is actually going up in the metros? So if the home demand is going up, then there should be more consumption of cement. Infrastructure is being rolled out at a frantic pace, at an unprecedented pace, in fact. But we still see that cement consumption has gone down. So I think getting more data in will be important, and also the fact that there are many unprecedented factors that are starting to play in. Man-made conflicts being one, the natural disasters being the other, and the fact that we are also switching industries completely. We're moving towards future industries, and therefore source of energy also becomes one question mark. If the whole world is moving towards electric or hydrogen, and green hydrogen for that matter, where even the Indian government is significantly betting on, why would there be a demand for oil as we move forward? So those are one aspects of.
But that is 2070 that we want to become carbon neutral.
Sure. But the movement is happening now, right? In the sense that if India and China are one of the largest consumers of energy,
right,
and both are moving out of this trap, whatever slow that movement will be, we foresee that there will be a hockey curve in that movement. There will soon be a large number of people switching over to electric vehicles, as an example. Now, vehicles are 80% consumers of, the 80% refined oil is consumed by vehicles. Out of that, again, 80% is consumed by on the highways, which is intercity. So if you can get the trucks to move into hydrogen, as an example, then there will be a significant impact on how energy gets consumed, right? And therefore, our dependence on oil will be going down. Also, if you look at the conflicts going on, those conflicts run on fuel. And each day there is massive amount of fuel that is consumed from both sides, which is both in this case, specifically we're talking about Ukraine and Russia. So they are themselves putting a pressure on how much of fuel is needed by the world. And therefore, when these conflicting data come up, because fuel is not bought on a daily basis, these are bought in terms of long-term contracts. When these contracts hit the market, that's when the prices swing, and we really don't have visibility on it. So what my point was that in the coming year, there is a lot of uncertainties from a global perspective, which is why, as you mentioned, there's a swing between 30 days ago where we were saying that the economies will go on a recession. 30 days later, we think that all will be fine. And we really don't know if the Ukraine war continues to happen. Energy from the Russian side is taken off the market. Gas is not supplied to the European Union. There'll be a trouble. What we also see happening is that energy is being routed through other countries and going back to Europe.
I think that's an interesting topic for another discussion, right? A separate discussion on that.
So I think in conclusion, and answering your question, is that there are too many unknown factors as we move into this year. I think every year the number of unknown factors are going up and up. And therefore, simply putting in a bet that oil prices will go down and therefore will have a very safe current account deficit may not be the wisest thing to do. We need to think of alternate measures if the oil prices go up significantly. Keep in mind that we went into the 1991 situation because of the Iraq war. That was the last push that we had, that we went into the kind of situation we had in 91. So we need to be very careful about how these conflicts impact us.
But I think we are better off in terms of the foreign reserves today,
Of course.
where we can withstand some major shocks.
Of
But of course, if the entire globe goes into some kind of a slowdown recession, we can't say that we are completely decoupled. There will be some impact on us.
Let me put the foreign reserves also in perspective. We have essentially got 9 months of imports
Right.
in foreign reserves, and therefore a conflict can lead to those 9 months getting eroded very, very quickly. So we had a smaller economy in 91, and in spite of that smaller economy, we had very little foreign exchange left. But in the context of the economy, we still have only 9 months of foreign exchange in our banks.
Interesting. So let's move to another sector, Richa, now, which is the backbone of the Indian economy and which provides employment to millions of people. And government has been very categorical in saying that we want to have a very robust MSME sector. There have been some announcements on the same and something in the fine print in terms of presumptive taxation as well as in terms of payments being made to the small businesses. Just share some perspective on that.
So yeah, this is these are two proposals which are there on two different perspectives, but really beneficial from the MSME perspective. While one deals with promoting simplification in taxation, the other is providing support with the cash management. So when we talk about simplification, there comes in the presumptive tax regime. Now what has been done is that for the existing regime which was there for small businesses, the threshold that was there for 2 crore, that has been increased to 3 crore. So the ambit has been widened quite a bit. Similarly, the existing provision, which was the presumptive tax regime for professionals, certain specified professionals, here again the current threshold of the earnings has been increased from 50 lakh to 75 lakh. But there is a very big presumption here. This benefit can be availed only when 95% of your receipts are in non-cash mode. So indirectly, it is promoting the non-cash transactions. So I think this again is going to benefit a large section of the small taxpayers. The other section which has been proposed is to support the challenges that they face on the cash flow level. Now, what is proposed is that if there is any payment which is made to a small an entrepreneur or an MSME, and it is beyond the time stipulated in the agreement, and the maximum time there could be 45 days, or it is a case where you do not have an agreement with that MSME, then 15 days is a threshold. So if a payment is made beyond that day, the payer will not be able to claim it on an accrual basis. It has to be necessarily claimed on payment basis. So I think this is a very radical change which will provide much relief to the MSMEs who are perpetually facing challenges on the cash flow front.
So I think this is a very important point which businesses should take note of, that just like some of the statutory payments and certain other payments like Provident Fund and others, if the payments are not made to the smaller businesses as have been specified, then there could be a challenge on tax reduction till the final payment is done. So I think that's a very significant change which has come in the fine print. Please take note of that. Riaz, in context of angel tax or in context of shares issued at price higher than the market value, it has always been a cause of concern, disputes and litigation. Various representations have been made from time to time. We have seen some movements forward, some movements backward, but the litigation continues. Now, this year we are seeing a significant change coming up in the fine print. What's your thought on that?
Great, that's an important issue that you've raised, Vikas. So, the provisions of the Tax Act actually spoke about if shares are sold at a price lower than the fair market value, then the difference between the fair market value and the actual price would be taxed as income in the hands of the issuer. Now, these provisions, while they were extremely well founded in rationale, they were applicable only to residents.
Mm-hmm.
The change that has happened is that now they've been extended to non-residents. Now, just a change to the non-resident will have some significant impact. On one hand, the FEMA provisions always allow you to bring in as much money as you want through the sale of shares from non-residents at a price even higher than the market value, just to encourage the greater inflow of foreign exchange. But with this provision, while it comes in here, it will be subject to tax in India, and therefore that benefit may be in conflict with the intent of FEMA.
And when you talk about the non-residents, let's cover one of the things which we feel is a miss in the budget in terms of capital gains. I think there was a lot of expectation this year that probably there will be a rationalization in the capital gains tax regime, because it has become a little complicated for different asset classes, different holding periods, long-term, short-term, and different tax rates. And in fact, there is a dichotomy also between resident and non-resident taxpayers. Do you think something should have been done this time, or we should wait for the future?
No, I think this is a long-standing demand, because the capital gains tax regime has become extremely complicated. Now, when you have different asset classes, different holding periods, indexation, then you have even a situation where assets are purchased in foreign exchange, they will be treated differently because it will be, the gains will be computed in foreign exchange. So there has been a long-standing demand just to simplify that whole regime. Now, only issue is that there are so many complications in this thing. It requires a deep study, and maybe it is something that would be expected to happen shortly, but maybe at this point of time, we were not ready to implement it. But I think something should be coming there very soon.
So on capital gains, what we have been recommending through various channels is that it needs to be a simpler regime, easier to understand and predictable as well. Because today when you do a computation mechanism, you actually need expert help in terms of determining the effective tax rates over there. I think the classification can be done between financial assets and non-financial assets, and financial assets could get further classified into equity and non-equity, but that's a matter of discussion and debate for some other day. Riaz, one more thing I think which is going to hurt the high income or high wealth earners is in context of the changes in capital gains deduction for the housing, where the benefit is getting restricted now, which was unlimited earlier. I think that's something that maybe the celebrities and high net individuals need to take care of.
Absolutely, as you said, people like you will be affected. Maybe we'll not have so much of a problem, but you have capital gains exemption under two sections of the Income Tax Act, which provide for exemption from capital gains if the proceeds or the capital gains are invested in other residential properties. Now, very welcome, because it encouraged more investment into real estate and helped the real estate sector also. But now what has been done is that this has been limited to a total cap of 10 crores. Mm-hmm. Now, with that 10 crore, definitely it will have an impact on all high net individuals and their ability to invest in high value properties. So I think there overall, even from the larger, more luxurious housing perspective, there will be an impact on the number of transactions. So I think, yes, that will have a significant impact.
I think what you are saying is probably it's a good problem to have if you have that kind of capital gain. I wish what you said, that if I had that problem, I would be very happy. Okay, Krishan, let's move to the GST. I think there is a change in the fine print which is going to impact corporate Inc., especially in context of the CSR activity. Input tax credit has always been a matter of issue, concern, debate and litigation. But there is a very fine change which has been brought in over there. What's your thought on that?
So because let me just take you back to when GST actually was introduced. The whole intention of getting GST by converting all the erstwhile different levies at state and center, there were different definitions of eligibility of claiming credit, say for VAT, for service tax, for excise, use in manufacture, use for provision of services, use in sale of goods. All of these were creditable, but there was very specific use-based, eligibility for credit. What happened in a GST when the consolidation happened? The definition also got consolidated, and there was a liberal meaning which was given to GST, because that was ultimately what the driver of the whole tax regime was, that just tax everything except for what is not, what is covered under the negative list, but at the same time give input tax benefit through the supply chain seamlessly by giving any item which is or service which is procured for furtherance of business. Now, when you interpret furtherance of business, it is a very wide ambit. Unless there is a specific, exclusion or a restriction which is carved out under GST for items which are for personal consumption, other, employee benefits, etc., gifts which are free of cost, etc. Everything was available as a set off, and that was the understanding of the taxpayers. Now, with time, when you actually started claiming that benefit, disputes started coming. Now, one of the things which was always open to litigation, and this was also under the erstwhile service tax regime, was the spending on CSR. Now, CSR spending is mandated, under the Section 135 of Companies Act, and that specific spending is on the activity of CSR, where you hand over that fund to, say, a NGO or an organization, or to a person who's going to build up that, activity which is permissible under CSR, and the company ultimately would be charged the 18% GST on the services which they buy. Now, there was an ambiguity whether this is furtherance of business or not. What they've done is they've now categorically put an exclusion that there will be no GST credit for the CSR spending. All the GST which you pay is a cost to you.
Kishan, just repeat this sentence, that's important.
So basically what they've done is they've put a categoric insertion in the provision of restricted items for the input tax credit, where they say no input tax benefit would be available for any spending of goods or services which you buy under CSR activity. So there is an average 18% impact on the CSR spending, which will directly be going to the government, which will not be claimed by you in your business as a business, expense for the GST purpose. Now, what really happens is that this also opens up plethora of other, issues which are coming out already. IPO expenses. There is a huge drive by the GST authorities that IPO expenses are in relation to trading of securities and they're not business expenses. So anything which is not directly linked to a furtherance of business or a direct business expense is seeming to be a case that government is being very clear that what is written in the print should be followed that way. There is not much room for actually expanding that definition by saying that this is furtherance of business. So it needs to be seen whether this will get clarified for other issues. I hope it does. But what is clearly brought out is that this expense will not be eligible for input tax credit. I think the other part of this, which probably, Riaz, you would also kind of look at is that this is also not an allowable expense under income tax.
Income tax, yes.
So if this gets added, then this is an additional disallowance which might happen for the income tax purposes also.
So I think the moot point over here is whether this expenditure should now be 100 plus GST or 100 is inclusive of GST. We will debate about it in some other forum, but I think that's a point which India Inc. should take note of. Riaz, insurance has been one sector which is completely underpenetrated in India. I think there has been demand from the insurance industry as well as the businesses and individuals to provide some relief over there. And ATC has been a popular section over there, but we have seen that the government's intent not to go for exemption and reductions. And few years back, we saw some tax element coming into insurance in respect of the KPI, key management. Yeah, in terms of those senior representatives of the industry as well as the businesses. Now, this year, again, a significant change has been brought in terms of bringing in the tax element from the EEE to EET kind of an element into the insurance. What's your thought on that?
Yeah, I think the change that has come in is that, when we speak about the claims under the insurance policies, the claims, when there's the amount received on maturity, it has not been subjected to tax, and that has been the normal way in which it has been taxed for a long period now. Now this year, other than ULIP linked insurance, if a new policy is taken from 1st April 23 onwards, and the premium, the annual premium payable in respect of that policy exceeds 5 lakhs of rupees, in that case, the amount which is received on maturity, other than amount received on death, will be subject to tax. So this is a significant change, basically from what we have been following in insurance taxation for a number of years. And it may be also argued that in a country where we don't have adequate pension schemes, this could have a negative impact. But having said that, it is related to the high value insurances and would not have a negative impact on the common man.
So is there a loophole that is the government is trying to plug in, or there was a misuse happening?
So investment in the garb of insurance has
Okay.
been followed for a long period of time, and therefore the returns from insurance policies as investment used to be significant. So to that extent, I think that is the gap that the government is trying to fill.
Okay. I think one more ask which the India Inc. had was on the 15% corporate tax rate. There were clearly two asks. One, to extend it, because a lot of time period was lost in COVID. Of course, the government came with a relief by extending it a little bit. The ask was about 5 years, and to extend it for any kind of new investments beyond manufacturing as well. But I think that was a clear miss in this year's budget.
No, absolutely. So the rationale for the ask is also the fact that if you have to set up a new unit, the likelihood of the unit being completed and starting production within a period of 1 year or 2 years is lower. So a longer period of time was sought. Now, when these extensions have been happening from 1 year, it becomes difficult for investment to be planned. I think this is an ask which remains. It is a miss, and we hope that something is looked at, because we continue to extend investments or these exemptions on a year-to-year basis. The counter argument is also that you can't give a 5-year extension, because that may prolong the actual investment for a longer period. So when investment is needed today, maybe it will get postponed to 3 or 4 years. So to that extent, a balance needs to be put. Maybe 2 years or 3 years and not 5 years should be the answer.
Richa, you have been working on the tax policy for India front as well as globally. I think TDS is quite unique to India in terms of so many provisions. If we count more than 3 dozen provisions, tax ranging from 0.1% to 40%. I think India Inc. has been demanding that this needs to be simplified. We haven't seen much changes happening in the last few years, even though that has been an ask every year. Your take on that?
Yes, I think that was one expectation that has been there for quite a long time now. Initially, when these provisions were brought in the statute book, they were limited to about 4 sections. And we have seen that over the years, they are now covering a whole lot of transactions, around 40 sections, as you mentioned. In addition, as a icing on the top, you have certain forms, you have certain rules also to look at. So, nutshell is that they are very complex. You have rates ranging from 0.1% to say 40%. There are low thresholds. And there are certain studies which reveal that typically there are just 3 to 4 sections which actually contribute to 80% of the revenue collections. Now, this tool which was created to establish a primary transaction tail was perhaps the right choice at that point of time, but things have changed. With the technological developments, with data available from so many other sources. We have GST, we have expanded SFT. A lot of data is currently available. So one needs to just give a fresh look to these provisions to see whether at all they are still required as a primary tool for transaction trail creation, or should they be restricted in those cases where a transaction trail cannot be created from other sources. So I think a time has come to take a look at it, because these have been an ever expanding set of sections.
Interesting. As per one of the analysis done by Grant Thornton Bharat, there are about 3 or 4 provisions both under TDS as well as TCS which contribute almost 80% of the TDS and TCS collections, and other sections contribute insignificant portion. I think the counter argument to that which we generally receive is that TDS and TCS regimes are being used in order to maintain audit trail. But as Richa pointed out, there is sufficient information available through the AIS information system, what the banks and financial institutions are submitting. So I think this regime requires a relook. Jayjit, let me come back to you quickly. There has been increase in the spend on healthcare as well as education. In fact, education was a specific point which the Honorable Finance Minister covered in detail this time. I know we will say it's not adequate, we need to do more, but I see a very positive direction in that. What's your take?
Absolutely. I think social infrastructure was critical. We were always being criticized that we're not spending enough on either education or health. And I think on both of these two issues, the government has come out and the budget has come out with actual targets of how much will be spent as a percentage of GDP. I think for health, it's about 2.4% of GDP that we're targeting, and a similar number or a higher number for education. And that also was mentioned in the context of the new education policy, which just means that we are looking at a progressive education regime and not just pumping money in. And given that we have a student population which is about 200 million, which again is almost the same population as entire Pakistan. So we need to educate such a large number of students. How do we do it with our existing infrastructure? We cannot manufacture teachers overnight. So there needs to be a massive digital platform that needs to be brought in. We need to address the issue at a war footing. Otherwise, our demographic dividend will turn out to be a demographic curse. And this is the only decade where either we grow or we become an economy which could have grown but could not grow, because we'll start losing our demographic advantage quickly. Now, if our people and our students are not trained and they're not skilled, and there were specific skills that were also mentioned in the budget, then it'll be a lost opportunity for us. So I think it's a measure that was urgently needed, and I'm so happy that the finance minister has put a focus on it.
So what you're saying is either we will move in a direction where we become an advanced, matured economy,
Right.
with about 15,000 to 20,000 per capita income, or we could get trapped in the middle income trap which many economies have fallen into.
In fact, it'll be a lower middle income. It'll not even be
Lower
upper middle income. It'll be lower middle income country.
Therefore, I think the direction is right, both what the economic survey and the budget are telling us in terms of spend on the healthcare as well as in terms of the education
Absolutely.
sector. Excellent. Riaz, anything else that you think we should have seen in the budget this year? Because I know there has been a lot of ask from the individuals also to increase the ATC deductions, etc. But the government has clarified no more exemption reductions. Let's move to a simplified regime, and that's exactly they are doing on the corporate side as well. Any other ask that we have?
No, in fact, as you rightly said, there is no limit to the asks. That year after year you have a number of asks which just come up and which may or may not be justified in terms of directional economic growth. And I think that the biggest thing that this budget has achieved is also trying to make sure that we continue on the path of absolute simplification, consistency. And with that, I think instead of falling prey to populist measures, prudent fiscal discipline has been the norm, and I think that is commendable.
Excellent. So I think what we feel is that the budget provides a robust platform for the future growth and development of the country. Of course, with a caveat, as Jajit mentioned, as to what happens at the global level as well. There is a lot of focus in terms of infrastructure build-up, both physical as well as soft, and also in terms of enabling India, Inc., individuals, as well as in terms of building the rural economy further. There have been some specific steps taken in the budget announcements in terms of dispute resolutions, and we expect that these will yield further results. And as Vishesh mentioned, budget is not an one-off event where all the changes need to be made. I think the changes should happen throughout the year, and that is what we have seen in a very positive manner, how the government, policymakers, as well as the administrative machinery has been very forthcoming in terms of receiving suggestions and also making the changes. With this, we will end our today's discussion. Thank you very much for joining in us today, and hope you enjoyed this discussion. If you have any specific issues or queries relating to the fine print in the budget, feel free to write to us and we will respond to you. Thank you very much.